Hello, Market Chameleons, and welcome back for First Call with Jay Kilby, aka the Doctor, King of the Discord.
Hey there, how you going, guys? You right?
Awesome.
Hey,
Before
Jake,
we
how's it
get
going?
too chatty and started, let's go right to this disclaimer. Get that out of the way. How about that, D?
Yeah, so as usual, guys, before we get started, keep in mind Will and I and Jake, Market Chameleon, we're not registered investment advisors or broker dealers, and we're not telling you what to do. We're just sharing our ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
All right. And here we get started with First Call. And there's a very scary scene behind you, Jake. Does that have anything to do with today's presentation?
Yeah, so sorry, guys. I need to turn the aircon on. I'm in the back of Hell's Kitchen. Been pretty hard, actually, on the Asia session. I think we were down 400 basis points on the Hang Seng on the back of some volatility around Evergrande, which you guys have heard, big Chinese property developer, 200 basis points, 2% down on the ASX 200. So being really, really hot. And I'm looking at the open in the States as well, looking pretty much to the downside, which is kind of cool with the the Hell's Kitchen background, but also what we're going to speak about today. And I thought I'd keep it. You've got my screen out in front of you there, which I'm sharing. I thought I'd kind of keep it lighthearted, and we speak about Vegas, right? So you've heard about the Chinese crackdown in Macau. It's going to adversely impact Las Vegas Sands, win a couple of publicly listed stocks in the United States. But then I thought, well, I need to keep it, themed to what we're working on. So it's going to have to be about volatility. Oh, sorry, I've just lost my track. So look, volatility is ahead. And I think what I mean by that is we're going to go back to the whiteboard and speak about some of the Greeks. And it's quite interesting because volatility overall, and something I share on the Discord pretty much on a regular basis, has been pretty much suppressed by, loose monetary policy, right? So we've had the Federal Reserve, we've had sovereign banks throughout the world keep interest rates at their lowest. And by doing so, they've kind of suppressed or sedated volatility. So let's just have a bit of a look at that. And it's really important to understand volatility because this is what really helps us generate tradable events, right? So if there was no volatility in the market, you wouldn't really have any tradable events, and therefore you couldn't, or it'd be much more difficult to take on risk and therefore gain some form of reward. So specifically, what is volatility? So a first order derivative, and I think we've done a few of them actually. So let me just get the little pen out there and do a bit of a recap. Sorry about that. Let me just get that rocking. So for all you buffs out there, I think we started off with delta, right? And delta was our directional risk. And then we spoke about theta. Theta is all about time decay. And now we're going to speak about Vega. So I try and keep them in English because I'm not very good at Greek. So this one, directional risk, this one, time, and then this one, broad terms, but volatility, right? So the other two, well, there's many actually, but the other two that I'll go over are rho around interest rates, and then gamma. And I think probably the two most important ones, gamma, at least in my mind, are both gamma and Vega. So anyway, let's just keep going. So, volatility, it describes an options price sensitivity, changes in volatility. An important part here, guys, it's in the underlying asset. So it's not specifically, for example, in the VIX. So it's the underlying asset, the underlying security we're speaking about. And it could really simplistically be described as the amount a stock price fluctuates. And what we're going to look at on the Chameleon a little bit later is that, I'm sure you guys have all seen this funky kind of bell curve, right, with equity prices described by a mean and then by a standard deviation to the upside and to the downside. And with less volatile stocks, we're going to have a standard or a distribution of returns, which is a much tighter one. And then with much volatile stocks, we're going to see this, we have a much wider spread, right? So Vega is actually a Greek, which isn't a Greek. It's only one of the only, for any of you guys doing pop quizzes or quizzes on, at the pub, or I don't know what you may do, but it's not actually a Greek letter, and dynamic and constantly changing. So that's an important point, because when you want to try and find or develop a benchmark with volatility, you've got to kind of draw a line in the sand, right? I'm going to see this a little bit later. With the Chameleon, we look at 30-day at the money implied volatility as a benchmark. And the reason why that's done really is because it's a happy medium. And we'll see this a little bit later. But if you go too close to time, so if you do a 5-day at the money implied volatility, you're going to undercook what volatility may potentially be. And if you go like 180 days out, you're going to overcook volatility because it's going to be much greater, at least in terms of the intrinsic value in the options price, right? So pretty important. And that's what I said, it makes up one of the things in options prices. It's an assumption and expectation of market participants. And another interesting point about volatility is it can have an impact on your options price, even if the stock doesn't move. So you can have stocks which, in terms of price action, are not fluctuating wildly, but the implied volatility will actually force the value of the option to the upside. It's very rare, but it does happen. And it could also do things like outweigh the theta decay and stuff like that as well. For the guys who sell volatility, sometimes, particularly on earnings events and stuff like that, sometimes referred to as premium. And then you guys have heard of the mantra of sell high and buy low. And one that I kind of embrace, but I kind of put a caveat to it nonetheless, because particularly with certain products, certain securities and risky assets, you kind of need to know what you're diving into before just blindly following a given mantra, right? So let's just get into options pricing. And I've got my magical cauldron here of what we stick in the cauldron to get our options price. And I'm sure there's quite a few of you guys familiar with Black-Scholes. Dimitri's mentioned it on several webcasts and stuff like that. We've got a couple of important things here. So we look at the underlying. Get my little magic pen out there again. Just stand by, guys. So we look at the underlying. We look at strike price as well. And when we speak about strike price, we're speaking kind of about direction, really, aren't we? So if you take something out of the money, at the money, or deep in the money, expiration date, we're speaking about theta decay. Interest rates, we're speaking about rho or rate, so to speak. Dividends are quite important as well. And we haven't really touched on them. And the reason being is, if you're the holder of a stock, you're obviously entitled to the dividend. If you're the holder of a long call deep in the money, you're not specifically entitled to it. So something important to understand. Also for people holding options short, if you're holding a deep in the money call short, then your assignment risk is super high and you ultimately end up paying the dividend. I know from experience, being there, done that as an adverse event. And then last but not least, right, we've got our implied volatility or our Vega. And like I mentioned, in terms of option pricing, I would put that up there as probably the most important Greek, along with gamma. And if I had to kind of, everyone's got their own punch list and stuff like that of what they think, but at least in terms of my experience, the least important one is probably rho. And that's because we've kind of sedated interest rates massively with all this loose monetary policy and monetary easing, et cetera, and all these measures which sovereign banks and central banks across the world have put into play. But in terms of like the ones that are really up there, the game changers in terms of changing your options price and creating tradable events, really for me, gamma and Vega. And then obviously theta is very helpful for understanding time decay on the value of your option and also directional risk with delta. So just a quick one here. If you're long volatility, often here on Bloomberg or any of these financial news media outlets or long vol, right? And people, I used to think when I was watching TV, well, what does long vol mean, right? So long vol can mean several things, one of which it means you're holding options long. So you're a buyer of either calls or puts invariably. And as volatility increases, that increases one of the components of your option and therefore increases the option's value in general. And the same can be said on the short side, right? So just a real basic, just a basic starter is I'm long options, volatility goes up, like volatility's gone up today. Irrespective of direction on your option, there is going to be a component of volatility which is going to positively impact that option's value. Okay, so Vega over time, and this links back to what I was saying about the MarketChameleon having 30-day at the money implied volatility. And the reason is because it's a happy medium. You need to have a kind of benchmark. Volatility is constantly moving. It's very dynamic. And it's very different, really, really further out in time, as opposed to being very close to present day, right? So my magical cauldron's here again. And volatility is a component, as a component in option price, is higher the further we move out in time. And then as we go closer and closer to time, that volatility component kind of decreases as things become more certain. And I really shouldn't use that term because nothing's certain really in life, is it? But that's kind of a way of looking at it. Another way of looking at it is if I asked you guys to give me what the S&P 500 will end at this week, and I took a kind of a census from everybody, I think more or less everyone, you might have a wide margin, but you're going to hit there more or less, right? You're going to be pretty much within that, within an acceptable range. If I then go and ask you in 3 years' time what it's going to be, the fluctuation is going to be huge, and hence that's why we see implied volatility being a much bigger component of an options price the further we go out in time. And that's also why I mentioned having that 30-day at the money implied volatility is ideal, because it's a happy medium. If you gave us like 180-day implied volatility, or at the money implied volatility, you would be overcooking volatility. If you came too close, you'd be undercooking it. So something really, really important to understand. And so I've got my Gandalf there with the AK, and this is the key point here, guys. Longer dated options in general, all things equal, have more vega, right? So this is another one. So volatility smile, and again, we're back in the realms of theory. We're not on our TWS or our Chameleon right now. I just want to get you guys, a broad understanding, a generic understanding of the building blocks which make up options prices, right? So volatility in general. So up here, you've got the actual volatility on the left-hand side and strikes as we move further up. At the money, volatility is generally where IV is at its lowest. And if we have out of the money calls and we move further out of the money, that implied volatility increases. In the money puts is the same. And likewise for in the money calls and out of the money puts on the opposite. Okay, so just a very broad and basic thing to understand. We can also see on the MarketChameleon, now if I've got time, I'll try and show you where you can see, that IV smile and how it looks. Now this again is really important to underline. It's theory, right? So in the real world is messy. Things don't work out like this, right? And so you'll find that this doesn't apply to things such as, or it changes is different for things such as futures products on, for example, currencies or whatever. So it's not the same for every basket of or every risky asset, and it really is just a visual display of how volatility behaves over a certain range of strike prices. So this one here with my main man Gandalf with the AK, I want to speak to you about a brief history of market turmoil, right? And we've got it's quite important because it shows us a couple of things. And if I can get my little magic marker functioning again, one of the things it shows, right, is generally volatility is a bit of a random walk which tracks within a range, right? This is not like the S&P 500 or the NASDAQ, which is constantly moving, well, not constantly, but it is figuratively, S&P 500 is kind of figuratively moving to the upside. It has a bit of a, an event like that, but it kind of looks like that. And likewise for the NASDAQ and, for example, the Russell. Well, if you look at the VIX, right, which is an index and futures contracts on the VIX, it is pretty much traded between 0 and 20, broad range based for a significant period of time. And one thing which characterizes it is these huge, explosive spikes to the upside, which we're just going to go over, right? So the first one, for anyone who's as old as I am, you probably remember the late 90s and the Asian financial crisis, which was essentially, I think 98, we had a kind of decoupling of the Thai baht, the Korean won, the Malaysian ringgit as well, and a kind of implosion, a currency crisis in Southeast Asia, where the IMF went in to try and bail out these banks and stuff like that. And something linked to that, not completely directly, but something worth looking at for anyone of you history buffs or people who like reading books, is a book, and they've got a documentary on it as well. You can hook me up on Discord if you want to find out more, but it's Princes of the Yen, right? And this is a book by a famous economist called Richard, I pronounce his name terribly, Paul Werner. He's a German economist, a really interesting guy I follow on Twitter. Pretty vocal guy in terms of political views and the like, but brilliant mind. And he actually did this long documentary or a whole heap. I think he did his PhD research working either for the Bank of Japan or living in Japan. And this was really tracing the loose monetary policy that the Bank of Japan kind of, put in place in the 80s before the kind of, the Japan that, the lost decade or the lost, 20 years of equity prices. And what happened was they ended up, not unlike maybe what we see with the Federal Reserve, they ended up inflating, risky assets, stock prices and housing prices in Japan before it all came tumbling down and imploding. And one of the interesting things that I remember out of that book, there was a stage, I think it was the late 80s or 90s, where Nissan, Nissan Motor Company, the OEM, the original equipment manufacturer, was actually making more money off futures trading on the yen or something like that, rather than assembling vehicles. And when that happens, you kind of got to think to yourself, wow, is something not right? It got me thinking a little bit about Tesla and Bitcoin. But anyway, we digress. Let's keep going. You guys know all about, particularly my friends in the United States. Oh, sorry, I lost my page there. You know all about the dot-com boom and bust per se, which was late 80s, right? And when we saw the NASDAQ, I think NASDAQ lost 50-60% of its value, right? So these things can happen. And then we saw this is the biggest one in terms of a volatility play, was the implosion of the world banking system with the subprime mortgage crisis, etc. And they made a few great movies. I think some of you guys may have seen The Big Short, read some of the books on that as well. Super interesting as well. But look at the volatility there up to 80. But it really is a black swan event. And we'll go back to that. Now, the one I want to kind of highlight, and we don't really talk much about this one, because first of all, it didn't really spike that much, but it wasn't systemic in terms of, in terms of wiping out, different swathes of capital markets, but it's Volmageddon. And Volmageddon, we're going to link this into some of the structured ETFs I'm going to show you later. But Volmageddon was an implosion of a bunch of structured ETFs around short volatility. And what a bunch of investment banks came up with, they came up with an idea which was essentially, look, I know volatility tracks within a range, like we can see here. What I'm going to do is I'm just going to short it, right? I'm going to short it, and I'm going to make my ETF's going to make progressive gains as I short the ETF. The problem with that, and this is why shorting, things like UVXY or some of these leveraged ETFs doesn't work, and I know I've been there and I've tried it, is these things can explode so far to the upside that they can wipe out investment banks and stuff like that. So look up Volmageddon for any of you guys who are interested in financial history. Credit Suisse was one of the big ones, and they had ETNs which imploded and their ETFs as well, and people lost hundreds of thousands of dollars, trust funds, retirees, pensioners, the works, because these people put hundreds of thousands of dollars in these products thinking I can short vol because volatility never moves, the Fed's always going to protect me, and so forth. And then when these things exploded, they went to they went so far up to the upside that it was just, rip your face off kind of volatility, which destroyed funds. So something which really needs to be taken into account. So last but not least, right, before I kind of get into the Chameleon very quickly and finish up, just show you some practical stuff. And this is me and me only, right? So this is not a recommendation for you guys to do it. I just kind of want to explain to you some of the things I do and some of the mistakes I've made and stuff like that. You've got a couple of ETFs which I use, leveraged ETFs, which have quite significant risk. I'm going to speak about a little bit later. One of them is VXX. So YOLO's on VXX right now. As I mentioned, volatility, with the VIX futures, VIX, the index, it pretty much tracks between 15 and 20, 25, whatever. And as I mentioned to you, it spikes really, really high up when it spikes, right? So it's pretty much tracks the same kind of thing. Well, what I do, rather than some people selling calls, which is extremely dangerous, and I wouldn't advise it whatsoever, is I'll buy long calls. I call them YOLOs, right? Because they're deep out of the money. They're not super expensive, and I'll take them like a couple of, maybe a month out or a month and a half out or 2 months out, etc. And 9 times out of 10, these make me no money whatsoever. So most of the time I'm a loser. It's a drag on the aggregate value of my portfolio. But when we have times like this, I think the VIX is up, when I'm looking right now, I think we're up 15-16% on the VIX. This thing starts to get all its value. And then when you've got these big explosions like we saw, 60, 40, 50, 60, up to 80, like we saw in the great financial crisis, this thing's making big cheddar. One which I use more often, and I've just got my little pen here, is UVXY. I'll do bear call spreads post-pop. Now, what I mean by this, let me just explain for any of you who don't know UVXY. I think it's a 3x or a 2x leveraged ETF on the VIX curve, right? So it essentially sells the front month, I think it's 30-day VIX futures contract, and buys the back month. Now, in periods of contango, which is a normal, it's like a normal futures, not futures curve, but normal volatility curve. Things are like this. And this essentially will be selling low and buying high. And the impact of a fund selling low and buying high is it ultimately implodes. And it's only propped up by reverse stock splits by the fund manager. And it was designed specifically for funds or whatever to kind of get inverse correlation to the SPY and you know, the S&P 500 or, you know, the Russell or whatever. So you could have something which is inversely correlated, but it's not perfect because first of all, it's using derivatives. There's a whole heap of things around compounding, etc., which make it kind of complicated. Well, what I'll do, and as you can see, this tracks down like this, and it ultimately has a glide path to zero, is propped up by the fund manager, but this will explode, right? So occasionally you have that, and it's once in a blue moon. Now, on nights like tonight, go check out UVXY or VIX, etc. You'll find that it's gone and moved markedly to the upside. What I'll do, and I'll probably do this tonight on my own account, is I'll then put a bear call spread on, you know, 4 weeks out maybe, just to wait till this thing calms back down and takes that glide path back to zero. So defined risk, so I know how much I'm, you know, risking. I would never put a short call on this or whatever because it's just way too dangerous. But defined risk and a bit of a play on volatility. Another one which is really cool, and we did this last week, you know, just chatting with Dimitri last week, was I think all you materials buffs saw what happened to uranium with, you know, maybe a bunch of guys trying to corner the market or whatever, a bit like the Hunt brothers with silver, I think back in the 80s or 90s, can't remember. Well, if you went on the Market Chameleon screener, you would have seen that uranium went through the roof. And one of the plays you could possibly do is, for example, what I did last week was I did an iron butterfly, right? So basically selling a put and a call at the money, and then basically just getting myself some protection on either side so I don't, you know, completely kill myself on the position. Worked out well. Not a big money maker, but I made money on the trade. Worked out well. And then last but not least, which is really cool, you know, we've got some really talented guys on our earnings channel. I can't profess to say I'm one of them, but I do follow a lot of them in on some of the trades they do, and we debate about a lot of stuff. We've got some really talented guys on our earnings channel who just do earnings plays, who will look at a lineup on a specific stock and then try and trade that. One of the things you can look at is vol crushes, right? So what typically happens on an equity or a stock price, excuse me, into earnings is often the stock will increase as we move into earnings. You can see this on the Chameleon. And then post earnings, the thing will just crush. Well, the volatility will crush in the option. The stock price may not crush or go to the downside, but volatility will crush as, you know, events around earnings, financials, etc., become more known. And therefore you can actually kind of play that with, you know, either a calendar or sort of some, you know, it can be a bear call spread or whatever. And that gives you kind of an idea. Some of the things that I do. And just, you know, a little bit, you know, I research and do a lot of work myself on, you know, volatility. And these are some of the publications. You can check me out on Seeking Alpha. Some of them I've done and that I trade, you know, so VIXY, spoke about UVXY. SDAL's another one, should be up to date, and VXX. But I want to put a real caveat on all these for all my friends who are the chameleons. And I think if there's anything you take away from today's chat is I want you to sort of kind of understand risk quicker than reward, because volatility can kind of blow a portfolio out of the water. It can blow a hedge fund out of the water. It can blow a bank out of the water. And particularly, and, you know, if you're interested in any of these, you know, synthetic ETFs that I trade on, go read the term sheet, you know, read one of my docs or whatever. It kind of gives a highlight of the risks and rewards. But a couple of things you need to be wary of is any ETF using leverage is usually doing it by over-the-counter derivatives. So they could be swaps or whatever. And when you're talking about over-the-counter, you're normally speaking about credit risk. So this is one investment bank dealing with another. It's not dealing with an exchange like you would see with a standard option, so to speak. And then the other one is particularly on ETNs, exchange traded notes, which have bond-like features. They have credit risk. So they have not only counterparty risk on the derivative side, if they're leveraged, but they also have credit risk as well. So big risks there. And those are the kinds of things I kind of want you to get a bit of an understanding on. So before we finish off, just last but not least, I just want to kind of link this to the Chameleon. I'm not going to go on TWS today, but for anyone who's interested, I use this all the time. Go stocks, go to price action analysis. And here, this is my IWM, but this is the Russell 2000 ETF, but I'm just going to put it on the S&P 500. Just makes it kind of something easy for everyone to relate to. And you can kind of, I've got it here, you can kind of set the parameters, 1 day period over the last 4 years, what are returns on the S&P 500, what's the price action, what are the distribution of returns. And this is super interesting because it helps you put in a position, like if you want to buy a call or sell a call or a put or whatever, you can kind of say, look, if I sell, 10% out of the money, what's that going to do? And you can run a quick check here and it'll tell you over the course of 1 day what's happened, right? There's been one observation where that's been below, et cetera, et cetera. But more interestingly, regarding what I showed you on bell curves, look at the S&P 500. It's pretty lean and mean. And what I mean by that is, it trades, it's not as volatile as some other things I'm going to show you in a minute. It churns its way or trods its way to the upside, often with the help of, whether it's loose monetary policy from the Federal Reserve or fiscal stimulus or whatever. But this thing generally, slowly but surely, trods its way to the upside, even though it's not happening today. And then interestingly, and you can see it here with the average negative move, when this thing wants to go down, it takes the elevator, right? And this is the same reason why volatility can be so destroying, right? Because you can think to yourself, well, volatility is going to be range bound over a certain period of time, no problem. I can short it, I'll sell calls and stuff. But that day, that when you get that black swan event, it can be so big and explosive, it can wipe a portfolio out. So that's really an important thing to, factor in. And, I think that's pretty much me rounded up for the day. Just one last thing, and you guys can hit me up on the Discord for any questions or comments or whatever. I'm just going to go back to my little article. Some people, and I did this when I started trading derivatives, several years back. UVXY, the thing is intrinsically designed to go to zero. Go read the term sheet, right? Why don't I just short it? Why don't I just hold it short? Well, there's a few very good reasons why, right? First of all, if you try and hold the ETF short, the hard to borrow fees, which will be invoked upon you by your broker, will often be so high that it'll outweigh any gains you make. And then beyond that, the explosive move to the upside. So, volatility is dynamic, but so is margin, right? Margin doesn't just stay like that for, this is your margin for the day. If things go wildly pear-shaped, that margin can change. And what will happen is if you get a huge explosion to the upside on something like UVXY, wait for the margin call. I happened to me when I first started trading, I thought, this is easy. I'm just going to short UVXY. and I learned the hard way, got blown out the water, really lost some serious money and survived to see another day. But look, the key thing to summarize, right? Vega is volatility, one of our derivatives. The two key ones, the two most important, really, volatility and gamma, at least for me, and then really understand your risk before diving into the reward. And that's me done.
Awesome job, Jake. Listen, we did have a couple questions. You mind if we get to them real quick from Rob?
Sure, no problem.
Rob was asking, I would like to know why Jake uses out-of-the-money long-dated calls of the VIX instead of at-the-money, and why not even longer than a month out?
Yeah, really good question. So I'll use out-of-the-money ones because I'm pretty stingy, right? So I'm looking for something which is relatively cheap, right? So I'm looking for a relatively cheap option. Well, cheap is a figurative term, right? Because each option is worth what it's worth in regards to its probability of success and stuff. But generally, it's just a very low capital intensive YOLO play. If you put it at the money, you're right. Technically, I'd benefit from you look at that volatility smile. So the options price would be cheaper from a volatility perspective. But I'm simplistically looking at that kind of blue moon event, which rarely happens. Like I said, my VXX trade, 9 out of 10 times I'm losing money. But that one time I make money covers those 9 times where I've lost.
Awesome, Jake. Great episode as always. Jake did mention a couple times the Discord channel. I put a link, I put my email in both the Zoom chat and the YouTube chat. It's williammcbride@gmail.com. You can email me about anything, but in particular, if you want a Discord link invite, to the channel that Jake has championed and started and helps run with Raj. Email me and I'll send you over a link. Awesome job, Jake. Any
Thank you,
final
Jake.
thoughts, Steve? There you go.
No, that was a great presentation. I thought that it was very good. As always, I think Jake makes an interesting presentation. Definitely better than mine.
Jake is one of the great presenters. I mean,
visuals.
it's so exciting watching your presentations and listening to them in particular. I'll have to go back and watch this one again. For those who don't know, we have a YouTube channel. This will drop immediately in the YouTube and be available. You'll be able to watch this presentation on volatility forever, which is great.
Sure. Yeah. Just one last thing as well for people who can't find me anymore. You can find me. I've just tried to change my name, ZMK Capital, on Seeking Alpha. You can find all those articles there. You can even ask me about them on the Discord. I'll give you my opinion and stuff, and also explain to you the errors I've made, because that's really what this is about, is trying to prevent you guys losing money like I've lost on dumb mistakes and stuff.
And that sounds like another episode, maybe in 2 weeks, Jake.
Okay,
Awesome.
no problem.
Great job. Let's hope we get out of this market today without this fiery background.
Okay.
Thanks,
See
Jake.
you later.
Thanks
See you
everyone
later,
for
guys.
joining.
Hell's Kitchen.
Awesome. Have a great day, chameleons. Trade in peace.